Live from New York City, heading for the biggest week of gains on the S&P 500 since June, following the biggest day of gains going back to April 2020. Good morning, good morning. The rally continues. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. The mount-up continues.
The release of the CPI report.
A total surprise, and it is definitely a welcome surprise.
This is an extremely welcome piece of news that we've been waiting for.
Everyone's been looking for this.
You can see the jubilation and the incredible move in the markets.
I love this current move.
This has been an astonishing move.
I think we're getting a little bit over our skis.
If you looked at yesterday's performance,
it was buy everything.
I don't think I can recall ever seeing from one trade to the next a 2.5% up move in the stock market.
I wouldn't think this is a change in the trend.
I don't think the Fed is going to stop because of this one number.
We can enjoy this for a week, 2 weeks, maybe get back to 4,200 on the S&P, and then I think the reality sinks in.
We still have a lot of volatility to go.
I don't think much really changed. It's a marginal positive.
And breathe. Joining us now to discuss the breathless price action, Pete Jim's Robert Tipp and Neuberger Berman's Eric Knudsen. Eric, first to you. What surprised you more, the data or the way this market responded to it?
Well, I think the data is consistent with the noisy, series that we're seeing. We got a surprisingly bad number last month and markets sold off. We get a surprisingly good number this month and markets react very positively. I think the magnitude of the reaction is perhaps surprising and maybe a little ahead of where we are really going. The Fed we're pricing in 50 basis points when the Fed had maybe gotten to 75. We're back to 50 basis points. It's not going to change the path of the Fed. They need to keep financial conditions tight for some time to come. And I think this is more just an example of the fact that we're living in the tails of return distributions now and for some time to come.
The one-day moves were crazy. Taylor Riggs is going to go through it in just a moment, but in the equity market, best day since 2020. In the FX market, the dollar just had its worst day since 2015. And in the bond market, Treasury yields, the 5-year, down the most since 2009. Robert Tipp, when was the last time you saw anything like this off the back of one CPI report?
Yeah, well, that's a good question. I would have to go back to statistical review. But I think it makes sense because the variation in the numbers is huge. We were running in the high single digits, and this number suggests that you could be dropping into the mid single digits. And I think the reason for the reaction is based on the fact that the markets were so cheap, were so, coming into this such high conviction on very big Fed moves coming ahead, and the magnitude, the difference of this, the idea that you could have a big drop down in the CPI. So I don't think we're out of the woods. I think there are a lot of dislocations out there, a lot of interesting aspects to this big picture. But the move makes sense given how far the markets had gone in one direction and the difference in the move and, frankly, some of the underpinnings that suggested this were coming.
Rob, do you think we've removed the risk of a much higher terminal rate than what was already priced in?
Absolutely not. I think when you go up to 100,000 feet and you're looking down on the situation here, there are a lot of cross currents that people are not really addressing. There's so much focus on the numbers. People have not seen inflation numbers like this. But are people considering the fact that, we're 10 years after the Euro crisis, we're 15 years out of the GFC, and you've never seen an environment of negative rates, of a 2% average 10-year treasury. And so I don't think people are realizing that the pandemic may have catapulted us back into this kind of 4% realm. So I don't think it's over because of this long-term structural view, but I also think people don't realize that post-pandemics, growth can be incredibly strong for very long times. This is, I think, a very healthy underlying backdrop, albeit with a little bit high inflation.
Eric, would you agree?
Well, we build on that and emphasize Robert's point that we believe we're going into a different normal. We're not going back to the new normal of the post-GFC environment with low yields, low inflation, financial repression. We're going more likely into an old normal environment of higher structural inflation, higher term premia, higher bond yields. It's going to be, a challenging and painful transition, but it can lead us to a much healthier place in terms of a proper cost of capital. But there are significant implications in terms of asset valuations going forward.
Equity gains continue up 0.5% on the S&P 500 this morning. Futures advancing. Three-part story. If you came into this week bullish, you were hoping for three things. I would say we got about 2.5 of them. You wanted gridlock in DC, almost there. You wanted a lower CPI print, we got that. China reopening, Taylor Riggs, just a subtle hint of that last one this morning.
And John, it is wild. I mean, again, you said that we don't want to be breathless here, but just give me a second to run through the numbers that we got yesterday after the close, which, to your point, continuing a little bit this morning. One of the best rallies we've seen since the depths of COVID, April 2020. 485 of the S&P 500 members are up. 100 of the 102 NASDAQ 100 are higher. 29 of the 30 Dow components were higher. 11 sectors within the S&P 500 were up at least 2%. 5 of those were up more than 5%. That were the numbers that we got after the closing bell, and it is just incredible when you think about the breadth of this rally. In terms of the actual numbers, all on that CPI print, you're adding $190 billion to Apple. Amazon is up 12%. You're adding, as you can see there, $100 billion on the day alone. You really don't get days like this very often. All of this came in a huge rally in the bond market. Bear with me as we go cross-asset. You had a 30 basis point drop in 5-year yields yesterday, some of the largest declines that we haven't seen going back since 2009. That's usually what you get in about a year. You got that yesterday in a day. Finally, take a look at dollar as we continue to go cross-asset. The single biggest one-day decline, weakness in the dollar that we haven't had in 10 years. It really was some of this dollar weakness that really gave risk assets a boost.
Weakness continues this morning. Taylor, thank you. Dollar index negative 1.35%. Currency pair to currency pair. Cable, biggest move back to 1993. Dollar yen, biggest move back to 1998. The Aussie, biggest move going back to 2011. And it's not just the FX market where we saw monster moves. Let's go single names on the S&P. Take a look at what happened with Apple, plus almost 9%. Microsoft up 8. Amazon up 12. Alphabet 7 to 80 percentage points higher. Big rallies from big names. Eric Knudsen, I'm looking at your calls. You're underweight US stocks, large, mid, small, across the board. Non-US developed market equities, underweight. EM equities, underweight. Eric, what would you need to see to make you constructive on this equity market?
We need to see an evolution of the growth inflation dynamic that we're seeing right now. Our expectation in 2023 is that markets are going to begin to focus on economic growth, and both real and nominal economic growth is likely declining. We need to get visibility into earnings. Earnings for 2023 are still forecast at $230 a share, up 5% from current levels. That's extremely unusual to see earnings growth increase when both nominal and real growth are expected to decrease from a top-down standpoint. Our argument internally is whether next year S&P earnings should be at 210, 200 or lower. It's not whether it should be at 230 or 240. Now, if we can get clarity on what could actually cause earnings to be positive in this environment, maybe it's a strong reopening pivot from China. Maybe it's evidence of a softer landing. That could get us more constructive on equities. But right now, we see a weaker risk reward, especially after the rally we've just seen in equities, and see better opportunities in other parts of the market, tactically, potentially in currencies. And from an allocation standpoint in fixed income, where short duration credit, we think offers a much better risk return trade-off.
It raises the question how much pushback we'll get from this Fed. This Federal Reserve does not want looser financial conditions. It does not want to signal that they're willing to back away anytime soon. We saw that from Fed speaker after a Fed speaker yesterday, including from Lori Logan of the Dallas Fed. The president of the Dallas Fed said this morning's CPI data, yesterday's data, was a welcome relief, but there is still a long way to go. Robert, do you think this Fed just wants to sit, and can it continue to sit on top of financial conditions given the price action yesterday?
Yeah, absolutely. The inflation numbers are really solid. I mean, we've stepped down, but the rate of inflation that you're seeing the last few months, and the trend that you can, try to divine out of this, that inflation is decelerating, it's still incredibly high. So I think that they're going to continue to try to keep financial conditions up at this level. I think the saving grace is going to be that the backdrop is, and I mean, there's a lot of talk on the hard landing and that everything is going to collapse and, and that this is not going to end well because of the high inflation. Definitely, it's hard to get a good landing here, but it feels to me like the job growth is really strong on a global basis. And if we get a little bit of luck in terms of the outcome in Europe and their gas situation, I think that growth could hold up and enable them to get this inflation to slowly come down over time over the next couple of years. So I think that, the earnings picture may hang in there. As Eric alluded to, the credit picture could hang in there a lot better than people think, even against that backdrop of where the Fed keeps the financial conditions a little bit restrictive here.
Rob, looking at the bond market and where Treasuries closed yesterday, down by more than 20 basis points, 2s out to 10s, your 2-year at 433. Let's call that 50 basis points lower than the intraday high of Friday's session, last Friday a week ago. On a 10-year, let's call it about 50 basis points lower than the highs of the year. Rob, some people sit here and say, I've seen peak inflation, I've seen peak bond yields. Do you share that view?
I think that we have seen peak inflation. It's going to remain high to moderate, though, and keep them on edge. I think that we're in the zone of peak yields, and there's going to be some offset in all likelihood between how credit spreads moves and yields. And so I think bonds are already back at a very wholesome, strategic allocation yield level. Are we going to have volatility over the next year or two as this sorts out? Yes. But overall, I think this is the level of financial conditions in terms of interest rates that's going to be around for the next couple of years. But that's going to be a setup for high returns, kind of like back in the 80s when the curve was incredibly flat, inverted. And we've seen this in the past. It tends to coincide with a high level of rates. So 5 years from now, looking back, we're somewhere in the zip code here of a peak for rates, in my opinion.
2s, 10s right now from yesterday's close, still negative 51, negative 52 basis points. Rob, Eric, you're going to be sticking with us. Equities right now positive 0.4%. We're up across the board. The rally continues. Coming up, a face-to-face with President Xi.
The meeting between President Biden and President Xi will be an in-depth and substantive opportunity to better understand one another's priorities and intentions, to address differences, and to identify areas where we can work together.
That conversation up next.
The meeting between President Biden and President Xi will be an in-depth and substantive opportunity to better understand one another's priorities and intentions, to address differences, and to identify areas where we can work together. Because working together to address common problems is in our interest, and because it is what the world expects of responsible powers.
President Biden shifting focus back to foreign policy, gearing up for his first in-person presidential meeting with his Chinese counterpart. This coming as China inches towards reopening with the biggest pullback of its COVID policies to date. Down in D.C., AMH. Morning, Anne-Marie.
Good morning, John. As you said, it's the first in-person meeting as President Biden is president of the United States, because he's met with him about a dozen of times over the course of the last few years. But, John, really don't expect much. What the White House is telling us is there's not going to be a joint statement. There's no deliverables going into this meeting. It's just so they can understand each other's interests better. And they really want to, quote, set a floor under this relationship. So that says to me that there's a really low bar of what to expect out of this meeting. But as you can imagine, the topics are going to be a really wide scope when it comes to Putin's invasions of Ukraine that will be discussed, climate change, North Korea. For the Chinese, it's going to be very important that they bring up what's going on in the tech world and the U.S. wanting to crimp some of their access to U.S. technology. And, of course, for Beijing, Taiwan is going to be top of the list.
AMH. Down in D.C. Anne-Marie, a busy week for you. Safe travels to the G20. We'll catch up with Anne-Marie throughout next week. We'll talk about that bailout on Monday. Then we've got to talk about President Trump, the former president, making a little bit of an announcement potentially on November 15th, and then on to the G20 as well. Bit of news for you on FTX just moments ago. I want to cross over to Abby for more. Hey, Abby.
Hey, John. Well, we are taking a look at FTX here and the bankruptcy news, and I'm just searching for these headlines right now that I'm actually struggling to find these headlines. Here it is. FTX Group says it has commenced its bankruptcy proceeding in the U.S. This is not a surprise. Clearly, John, we've been hearing about this for days. And the CEO of both the FTX Group, Sam Bankman-Fried, his assets, as you know, have plunged from $16 billion to zero in days. I'm taking a look at the crypto space. Bitcoin, we have plunging down about 5%. Ether also down about 5.6%. But the big headline here is the FTX Group says it has commenced bankruptcy proceedings in the U.S. Not a surprise. We've been hearing about this for days, so we now have confirmation of what had been speculation, and it is now appears to be fact, John.
Bankman-Fried, as well as resigned as CEO. John J. Ray III, appointed CEO of FTX Group. Going to catch up with Sonali Basak in just a moment on this, I'm sure. Robert Tipp, Eric Knudsen still with us. Eric, I want to cross over to you just briefly on this story. I've asked this question a few times over the last 24 hours. I think it's important. The potential for contagion from this particular asset class, what's happening with crypto, the developments of the last few weeks, and what you think could happen with developed, traditional asset classes. Do you see the scope for contagion here from one to another?
Not necessarily from crypto. I mean, the big question we're asking across the board right now is what are the known unknowns or even the unknown unknowns, if you can identify those in any way, that could cause what has still been a pretty orderly kind of market move this year into something quite a bit less orderly. We saw an example of what could do that in the UK in late September. Crypto does not appear to be that potential systemic catalyst. And when you think, a couple of years ago, there was $190 billion of crypto net worth. It went up to $2+ trillion, and now it's back down to $900 billion. That's all happened both in a period of extraordinary liquidity going up, but that decline has come down and really not had knock-on effects. And so partly that's probably because there was a lot of wealth created still in that space. And second, it's been somewhat disconnected from the broad market, in terms of the overall flows. So we're watching closely, but we don't think that's necessarily the systemic risk catalyst.
Robert Tipp, I just wanted to give you the final word on that. The conversations you might be having with clients and colleagues on this particular topic, what are they?
Right. Well, I think it's been crash tested pretty well, this market. I mean, it was pushing 70,000. Now it's under 20,000 on Bitcoin. It's been a large market cap. It's been crushed. There's been money literally stolen out of these different wallet hack incidents. So if there was going to be a spillover, I think we would have seen it. But I think the best thing that could happen in this market would be that it gets some regulation to give it some legitimacy. Otherwise, it's going to remain kind of like an off-track betting kind of situation, which is very interesting, has fascinating technology, but is going to remain, a little bit unlinked from the main system.
This one's been messy, that's for sure. Robert, thanks for being with us today, sir. As always, Robert Tipp and Eric Knudsen. We're going to pick up on that story a little bit later this morning. FTX Group commencing bankruptcy proceedings in the United States of America. Now we're going to cross over to the New York Stock Exchange as they hold a moment of silence in honor of Veterans Day.
A more measured approach to rate increases might be particularly useful as policymakers judge the economy's response to higher rates. Already, we've seen the committee's policy actions lead to a very sharp tightening of financial conditions.
Stepping down is an appropriate thing to think about. I support a more gradual approach of getting to it so we can be discovering the right rate as we go.
While I believe it may be appropriate to slow the pace of rate increases so we can better assess how financial and economic conditions are evolving, I also believe a slower pace should not be taken to represent easier policy.
In light of the cumulative tightening we have achieved, I expect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points would still be significant.
The Fed speaker the last 24 hours following CPI, and this market absolutely ripping through yesterday's session. I can tell you in the last couple of minutes, rolling over just a little bit on the S&P, still positive 0.2, but now negative on the Nasdaq. The news of the last 10 minutes or so, FTX commencing bankruptcy proceedings. Shonali Basak, a Wall Street correspondent, is going to run to the set and break that down for you in about 5 minutes' time. Before we get to that, let's get you some of the morning calls this morning. First up from Deutsche Bank, naming Walmart as top pick in retail, saying the stock could be a defensive winner. That stock is up a third of 1%. Piper Sandler downgrading Occidental to neutral, seeing greater upside elsewhere following the stock's recent outperformance. That stock is up by 1.5%. And finally, JP Morgan downgrading Intel to underweight from overweight, expecting other chip makers to continue stealing market share for another several years. That stock is down by 2.9%. Coming up, he's said to stay bullish this week, and wow, has that paid off. We'll catch up with Morgan Stanley's Mike Wilson, and we'll break down the breaking news of the last 10 minutes or so. FTX Group saying it's commenced bankruptcy proceedings in the United States. Shonali Basak on that, Mike Wilson on the price action, all of that coming up. Equities up 0.2%. The opening bell just around the corner. Trying to get you to the weekend, about 24 seconds away. I'll bring you the opening bell. Equity futures right now just about positive on the S&P by a third of 1%. The Nasdaq turning negative by a tenth of 1%. Those two moves following the biggest one-day gain on the S&P and on the Nasdaq going back to April 2020. We've got some news to deal with. We'll get to that in just a moment. There's your opening bell. Switch up the board and get to the bond market. 10-year yields look like this in Germany. The bond market is open. The Treasury market closed for Veterans Day. Right now in Germany, up 13 or 14 basis points on a 10-year. 214, let's call it 215. In the FX market, the dollar weakness continues. Yesterday, the biggest one-day move lower on the dollar index going back to December 2015. Today, more dollar weakness. DXY down about 1%. Euro dollar positive 0.9%. 102.98. Crude right now, 89.21. We're positive on crude off the back of the China reopening story. Breaking news of the last 15 minutes or so, FTX filing for Chapter 11 bankruptcy. The company's controversial chief executive, Sam Bankman-Fried, resigning as CEO and will remain to assist in an orderly transition. Let's get to Shonali Basak for more. Hey, Shonali.
John, orderly is difficult when you have an entity that has 130 entities across the globe really looking to file for bankruptcy and receive whatever assets they can to make some investors partly whole again. However, the value of a lot of their holdings obviously have fallen dramatically. You have FTX Trading, the FTX US entity, Alameda Research, which is Sam Bankman-Fried's trading shop, and again, like I said, the 130 additional companies. There's certain subsidiaries that are not part of this filing. LedgerX, FTX Digital Markets, an Australian entity, and an ExpressPay. What happens to those is a little bit unclear, but remember, the ones that are filing have a lot of things that they're invested in as well, and a lot of counterparties that we don't know how they will fare through this.
Leverage on top of leverage on top of leverage. Shonali, have you got any insight into that whatsoever on the who's next to this?
You know, one of the people that are kind of larger speakers in this industry had said that we were looking for contagion in the industry. This is the contagion. This has been happening all year, and it has accumulated to FTX. However, remember, counterparties, large investors, SoftBank is expected to take a $100 million hit off of this. Sequoia bringing their holding down to zero, dented confidence in the venture capital industry. Not a lot of dry powder left to save other folks that might be feeling more pain. And again, other companies that might go down. The fact that BlockFi has also said that it would be pausing withdrawals has a lot of people equally worried as what is happening to FTX, because you're going to have more customers feeling pain. And again, a lot of these are brokerages and retail investors, so they may never be made whole.
Janelle, stay close. I'm just going to work through the opening band. I'm going to come back to you in just a moment. About 2 minutes and 30 seconds into this on the S&P, positive about 0.1%. Pretty muted price action relative to yesterday, of course. Energy rallying back by 1.6%. Healthcare negative 0.6. Staples down 0.4. Utilities down 0.4%. Abby, elsewhere, there are some big moves out there.
There are certainly some big moves related to that FTX bankruptcy headline, that announcement, and what is happening there. And of course, it has to do with the crypto space. We have many crypto stocks at this point plunging. And if you recall yesterday, going along with the risk on mood, we had a big rally after days and days of brutal action. In fact, a year of brutal action. But you can see today, Marathon Digital down nearly 10%, Coinbase down 6%, MicroStrategy, Riot, Blockchain also down about equal amounts. And of course, these stocks are also down sharply over the year. Coinbase in its short lifetime is down 85%. So some of this uncertainty around the crypto space and the possibility of what we're seeing relative to this liquidity crunch, the fallout of FTX, not so surprising. But the big question that you and Sonali were just talking about, and everybody's been talking about for a few days, what does it mean for the broader equity markets? The S&P 500 E-mini futures earlier today had been up 0.9%, taking a leg lower on these headlines. And also over the course of this year, we have crypto and the S&P 500 trading in lockstep. If we go into the Bloomberg terminal, we can see that. The big question is the recent plunge that we see there in Bitcoin, and Bitcoin, by the way, taking a big leg lower on these headlines, right now down 7%, earlier down just about 3%. And frankly, earlier it had been higher. But you can see that divergence right there, John, between the S&P 500 going higher, Bitcoin going lower. Can these two risk assets go in that direction, especially as we try to figure out how far and wide this liquidity crunch stretches?
Hey, Abby, thank you. Great work as always. Sonali, just a final word from you, please.
One other company that I'm watching, frankly, is Skybridge, because they're just one investor out of many that have been making this crypto pivot. They bought at an average price of $18,000. You have crypto, Bitcoin now down to $16,000. Imagine just how many investors, John, large investors, are in the red today.
Painful stuff. Sonali Basak, Sonali, thank you. Sonali's going to run you through the story all day on Bloomberg TV and radio. We get lucky this morning. Morgan Stanley's Mike Wilson, in the last week, came on this program and said, stay bullish. That paid off in a big, big way. Mike Wilson joins us right now. Mike, can we just start with this mess playing out in crypto all around us with things like FTX? What does it mean to you, Mike, looking at the broader equity market?
Yeah, I mean, look, this is financial contagion risk. I think part of the reason we rallied so much yesterday, quite frankly, is because I think there was people putting crash protection on into what was, an event that had been obviously previewed for several weeks. I mean, the CPI release was the event. It was actually the fourth event in 2 weeks that we've been focused on, that we've been kind of waiting for to finally get this rally in bonds, John, that we've been talking about, it seems like, for months. And, the four events were the Fed itself last week, which, remained hawkish, but, kind of opened the door to a step down in terms of pace of rate hikes. And then, of course, we had the strong non-farm payroll number. Then we had the election, which I think will lead to a mixed government at the congressional level. Maybe not a red wave, but enough to block, crazy fiscal next year. And then we got the CPI, which really confirmed a view we've had for a while, as you know, which is that inflation has peaked, and it's probably going to come down pretty quickly. So all that leads up to what we think was the fattest pitch in the market, which was going long duration. And that will lead to the next leg of the equity rally, because as rates come down, what I think will happen is, and we saw this yesterday, so it's good confirmation, the NASDAQ, which has been the laggard in this rally so far, can now catch up. And that's what happened yesterday. I mean, obviously the whole market was up, but it was led by, these longer duration growth assets, and that's tied directly to the move in rates. So that's basically our call to a T. The tricky part now is going to figure out, okay, when is it over? I don't think it's over yet. I mean, clearly this overhang from crypto is not constructive. But I think what it did yesterday, I mean, we saw a big retail selling yesterday. So it's amazing to me is that we're having this event, which is a little bit scary, and yet the market was up, 6, 7, 8%, depending on which one you're looking at, which tells me that people were just out of position. So probably further to go, I would say through Thanksgiving, maybe even into early December. Us, John, we'll manage this tightly. We'll be disciplined, but I don't think the rally's over at this point.
Mike, have you had a rethink of the range, the initial range that you introduced for this bear market rally?
Yeah, so 4,000 to 4,150 was the range we targeted on the S&P 500. As I mentioned earlier, the Dow Jones and the small cap index actually already exceeded its 200-day moving average pretty substantially in the case of the Dow. So as the Nasdaq maybe gets towards its 200-day, we could actually see the S&P maybe go through its 200-day to the upside. I mean, I don't know. I mean, it's hard to be that precise because we do think this ultimately is a bear market rally. But once we get through the 200-day, that'll probably get the animal spirits going even more. That'll draw in more, kind of passive flows that track that type of data. And we could see an overshoot, I mean, I wouldn't rule it out. Something like 4,200, 4,300. We'll just have to wait and see how it goes, John. It's going to remain volatile. This is not the kind of market that the average person should be trying to trade. This is a trading call. It could be very profitable if you count it right. But it's still a bear market, so it can rip you apart.
Mike, what is it about Q1 earnings, or rather Q4 earnings, that you'll see in Q1 that you think ultimately make this a bear market rally and nothing else?
Yeah, so it's just finishing the original thesis, John. As you know, the fire and ice is just not complete, right? We've had clearly way too much fire with inflation. The Fed has reacted to that. That's really what the bear market's been about so far. I would argue that the crypto collapse is directly the result of tighter financial conditions, and that began over 18 months ago, so this is not new news. What is new news, or I think what's going to be new news, is how significant the negative operating leverage is going to be next year for a lot of companies. We've got a sampling of that with the big tech companies, obviously, in this last earnings season, and I think it's going to be quite broad. So, as we've said on this program a million times in the last couple of months, we ultimately think the earnings forecasts for next year are substantially too high, and we think that process of readjusting those estimates will begin in the fourth quarter reporting season, because that's when companies will have to address 2023 forecasts, which they haven't done yet. And that's the catalyst. There could be other catalysts as well, but that's the main one. It's basically the slowdown that will hit earnings significantly next year, even in the event that we avoid a recession, which we think is getting less likely. But if we do avoid a recession, that means less employment cuts, which means even worse operating leverage. So that ultimately has to play through. Does that mean new lows are guaranteed? No. But I would say a retest of the 3,500 level is probably pretty much in the cards. And then we ultimately think that will get taken out.
Can we talk about the cost cuts we're seeing in tech at the moment already, the tech austerity? Amazon reported by the Journal yesterday that they're going through a cost-cutting drive. And this was a number that jumped out to me just on the amount of jobs growth we've seen at that name. Between the end of 2019 and the end of 21, Amazon hired more than 800,000 employees. Just how much excess do we need to work through here, Mike? You've been thinking about this for a long time. How much excess is there that we need to cut?
Yeah, and like everybody, I mean, we get caught in our own narrative sometimes, and so we've been looking at this. We've been waiting for this for 9 or 12 months, as you know. I mean, this is part of our thesis, and so then when it starts happening, we start to question, okay, well, is it priced? And I would say I don't think so. In other words, I think this is the first of many cuts that we're going to see, not only for these companies, okay, but companies writ large. We've seen over hiring, over inventorying, over ordering, and that all has to get wrung out of the system. Some companies will navigate that quite well. That's why we've been focused on this factor of operational efficiency so much all year, John. We think that will continue to carry the day, meaning own companies that didn't over hire, didn't over order inventory, et cetera, and then they can manage through this. I think that, look, this is another reason why NASDAQ can have a big catch-up move, though. These companies are starting to take action, right, finally. And that's a positive. I mean, as we've said to you on this program before, I mean, one of the things we'll look for, for the end of the bear market is when we actually do get an employment cycle, right? Because then the bleeding will stop on the margins front. But we haven't seen that yet, broadly across the economy.
A bit softer this morning. 11 minutes into the session, we're down 0.2%. On the Nasdaq, we're down 0.1%. I want to break down that breaking news of the last 15 minutes or so. FTX commencing Chapter 11 bankruptcy. We've talked about the risk of contagion from crypto, perhaps into traditional asset classes. Peter Chu of Academy joined us on this program yesterday. Take a listen to what he had to say.
What does this do for the economy slightly longer term? You're going to see less spending on semiconductor chips, right? They were huge buyers for these mining rigs for all the software that they needed. You're going to see less ad spending, right? We might finally be able to get through a sporting event without Matt Damon telling us to, march off to do something exciting. And finally, I think we're going to see less energy use as mining drops. So there's going to be a lot of real world repercussions from this.
Mike, I'd love to give you a final word on this. What you'll be telling clients today about what's developing in crypto and what it means for them.
Yeah, I think that guest comments were right on. It's part of the kind of binge spending on a bunch of things that we saw. I mean, we've talked about this for semiconductors for a while, that you had a pull forward on a lot of different areas, and crypto mining was one of those. Okay, and that's ultimately going to have to reset. And I don't think the semiconductor cycle has bottomed as a result of that. Our analysts feel the same way. There's going to be more bad news. It's not just crypto. Okay, it's also we overconsume PCs and handsets and all this electronic stuff. But ultimately, it will lead to a new cycle. Okay, what I want people to focus on now is this bear market is not new, right? I mean, this has been going on for 18 months. And I think, some people have just kind of figured it out maybe in the last 3 or 4 months. And so we're now in the mindset. We want to be more balanced in our thinking. We've been very bearish for 12 months, and we're just starting to, be more balanced here. That's why we made this trading call. And that what investors should be doing now is finding companies, finding investments across the entire capital structure that they want to own for the next 2 years. One of the areas has been in rates. We think bond prices got to a really attractive level, both, at the Treasury level as well as at the investment grade level. That's an area you can put real money to work today, and then picking a few stocks here and there as they kind of come to your price targets. We're in the final phase. It's going to be volatile. It's going to be really hard to trade. Okay, we don't advise people try and trade it. We're trying to trade it because that's our job. All right, but we're ultimately going to be making the final low, where the big fat pitch we think is probably within 3 or 4 months, but not everything will bottom on the same day. It's every investor's job to kind of find the price that makes sense at the stock level or at the security level when it comes to them.
Mike Wilson, wonderful as always. Mike's words this morning: it is still likely a bear market rally that can rip you apart. Mike, we appreciate your time this morning, sir. Thank you. About 14 minutes into the session, we're down 0.25%. Shonali, you've been breaking this story down. It's still developing. What do you see?
Just something that Mike Wilson said that I think is important that you have to consider here, John, is that the crypto crash here was a direct result of tighter financial conditions. And I just took a quick look on our bankruptcy page here, and it's true. You do see a lot of people having hired restructuring advisors, but that window of companies is widening. Even Elon Musk just yesterday saying that Twitter bankruptcy is possible if there's a cash burn that lingers, and the banks, including Mike Wilson's own bank, are trying to sell this debt at discounts as low as 60 cents on the dollar. That's the steepest discount in a decade. So if you're looking for money in a troubled market, where are you going to find it? It's going to cost you at the end of the day, and that's the fear that I think Wilson is hitting on. And frankly, the FTX story, the bankruptcy, is just the beginning of the rest of the pain we may feel.
Let's keep talking about it. For sure, in the bond market right now, it's a buyer's market in a way that it hasn't been in a long, long time. If you're just tuning in, good morning to you. About 15 minutes into the session, equities down about 0.1%. Coming up, we'll catch up with Emily Rowland of John Hancock on this crypto mess and what it means for you at home. From New York, this is Bloomberg.
I don't have the exact number, but I think at least we are talking about billions here. Right now, I think the most important thing is still we need to do a full due diligence to have a full picture of what's going on, how serious is the liquidity crunch.
Breaking news in the last 30 minutes. FTX Group says it's commenced bankruptcy proceedings in the United States. The group says that Sam Bankman-Fried has resigned as CEO. John Hancock's Emily Rowland weighing in on the long-term impacts of FTX's blow-up, saying the following: we are likely seeing a game-changer week in the cryptocurrency markets. Institutional interest will likely never be the same. We see massive write-downs still to come across the industry. Emily joins us right now. Emily, let's build on that. What do you make of this mess this morning?
Yeah, John, I mean, the thought about liquidity and the speed at which these exchanges process trading is really, under review right now. And I think the fact that these exchanges are not allowing withdrawals or distributions is going to put a major, major dent in investor trust. There's really no backing for these exchanges. We're probably going to see more write-downs here. It's a really, really challenging backdrop. And I think for a lot of us, a reminder of how important due diligence is. That can often be forgotten during bull markets, and it can help minimize losses. It can help investors allocate capital properly. And I think when we look back on this cycle, unfortunately, this is going to be a hallmark of this long-lasting legacy of the misallocation of capital.
Emily, is it too simplistic just to say that this mess is just about higher interest rates exposing the lack of discipline across one industry?
I think that's certainly a huge part of this story. I mean, the massive amount of stimulus that fueled this incredible amount of risk taking is certainly part of it here. So we want to think about that. And as we look forward, we're continuing to see this wave of liquidity, this tide of liquidity going out, and it feels almost like a game of musical chairs, where we're going to be left to see, which players are over levered, which players have we not conducted the due diligence on, and that's one reason we want to continue to find opportunities in higher quality parts of the market that don't have these issues, haven't taken on excessive leverage, and have plenty of cash to make it through this decelerating growth backdrop.
Mike Wilson of Morgan Stanley was on 10 minutes ago. He said this is still likely a bear market rally that can rip you apart. Bob Michael of JP Morgan Asset Management was on in the past week, and he said he thinks this might be the calm before the storm. Emily, what's your sense of that? Is this the calm before the storm?
Yeah, I loved hearing Mike say that, and I think it is. The market reaction to the CPI report yesterday was just a massive wave of short covering, and it wasn't entirely unexpected to see inflationary pressures moderate. We've been expecting that. And by the way, if you thought yesterday's CPI report was soft, just wait until the housing market starts to catch up. We looked at the shelter component of the report yesterday, responsible for nearly half of the month-over-month gains. With mortgage rates now around 7%, we're absolutely going to be seeing a precipitous decline in home prices from here, and inflation is going to fall further. You also look at the comps. They were much higher last year. Last year at this time was really when that wave of inflation started to come through. So, inflation is going to fall. But what I think investors are missing here is that CPI always declines into a recession because demand is slowing. And John, markets are simply not priced for that scenario right now.
That's the next problem we've got to get our teeth into. Emily, I'm going to give you the final question of the week on this program. What do you use this strength for then, if you are this bearish still?
John, the holidays are coming up. What I would suggest you buy your friends and family are bonds. We look at the income on high quality bonds right now, 5-6%. You're getting over what you've gotten in the last 10 years. We haven't seen yields like this. We like the income. We're taking it all day long. The leading indicators are negative for 3 consecutive months. The yield curve is the most inverted since 1981, telling us something is wrong with Fed policy here. We expect to see a big earnings decline. A normal earnings recession is about 20% plus going into a recession. We haven't even started to see that yet. So look to the income on higher quality bonds as the best holiday gift you could give your friends and family.
I'm not sure my mum wants T-bills for Christmas, but I'll give it a go. Emily, love it. As always, thank you. Emily Rowland there of John Hancock. Let's get you to the trading diary. That's coming up next. What a week it's been. Live from New York, this is Bloomberg. "25 minutes into the session. We're almost there to close out the week. Equities unchanged now on the S&P, on the Nasdaq, basically unchanged as well. As some of the price action muted, of course, relative to yesterday. Let's get you to the trading diary. Tons to watch into the weekend. You, Mitch, sentiment survey, top of the hour. President Biden speaking from Egypt at 10:15 Eastern time. Then heading to Cambodia over the weekend for a summit with leaders of Southeast Asian countries. Chinese President Xi Jinping and Biden meeting face to face in Indonesia ahead of the G20 on Monday. Fed speak picks back up. Waller, Brainerd, Williams all next week, and then US PPIs on Tuesday. And a ton of G20 stuff as well. Looking forward to that. Looking forward to covering it with you. Almost at a weekend. Deep breath. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.